Investing with a mad scientist mindset. Great Scott! You know what Doc Brown and Warren Buffett have in common? They both understand the power of compound growth. They both take calculated risks. And they both look absolutely insane to everyone around them until they succeed. The difference? Doc built a time machine. We're building wealth. Same energy, slightly fewer paradoxes. Welcome to financial experimentation. Let's get dangerous. Hey everyone, welcome back to the lab. And if you're new here, subscribe now, because today we're doing something a little different. We're throwing on our lab coats, grabbing our beakers full of index funds, and approaching investing with the unhinged brilliance of mad scientists. Now, before you click away thinking, this person has finally lost it, hear me out. Mad scientists have a methodology that, when applied correctly to finance, actually works. They experiment relentlessly. They embrace controlled chaos. They think in possibilities, not limitations. And most importantly, they're willing to fail spectacularly in pursuit of breakthrough success. Today, we're channeling iconic mad scientists like Doc Brown from Back to the Future, Rick from Rick and Morty, and even Dr. Frankenstein. We'll extract their genius, filter out the actual insanity, and apply what's left to building your investment portfolio. We'll cover the mad scientist investment philosophy, how to run financial experiments safely, high-risk, high-reward strategies that actually make sense, and how to avoid blowing up your financial laboratory. Fair warning, this video contains science, sarcasm, and investment strategies that your traditional financial advisor would absolutely hate. But that's kind of the point. Let's fire up the flux capacitor and get started. The mad scientist philosophy of investing. Let's establish our foundation. What makes someone a mad scientist versus just a regular scientist? It's not the madness, it's the mindset. The core principles. Principle 1. Failure is data. When Doc Brown's experiments exploded, which was often, he didn't quit. He took notes. Every failed flux capacitor prototype taught him something. Every temporal paradox gave him information. In investing, your losses aren't just losses. They're expensive education. That stock you bought because your cousin's friend's barber said it was definitely going to moon. When it crashed, you learned about due diligence, that crypto UFO mode into at the peak, lesson in emotional discipline. The mad scientist doesn't cry over spilled chemicals. They analyze the explosion, adjust the formula, and try again. Practical application. Keep an investment journal. Not just what you bought and when, but why. What was your hypothesis? What happened? What did you learn? Treat every investment like an experiment with documented results. Principle 2. Think in probabilities, not certainties. Doc Brown didn't know if the DeLorean would actually work. He calculated probabilities. He ran the numbers. He assessed risks. Then he strapped himself in and hit 88 miles per hour anyway. The stock market doesn't deal in certainties. Anyone promising guaranteed returns is either lying or committing fraud. But we can think in probabilities. A diversified index fund has historically returned about 10% annually over long periods. That's not guaranteed, but it's probable based on a century of data. A random penny stock your friend mentioned has a probability closer to absolute disaster. Different experiments, different probability of success. Practical application. Before any investment, ask, what's the probability this works? If you can't articulate a reasonable answer backed by research, you're not experimenting, you're gambling. Principle 3. Controlled chaos. Mad scientists aren't reckless. They're strategically chaotic. Doc Brown didn't randomly throw plutonium around. He had calculations, safety protocols, and a very specific plan. Sure, he hung off clock towers and drove into lightning, but it was calculated hanging and lightning driving. Your investment portfolio should embrace this. Yes, take risks. Yes, try unconventional strategies, but with guardrails, practical application. The coarse satellite approach. 80% of your portfolio is boring, stable index funds. The safe, predictable core. 20% is your experimental lab, where you can try individual stocks, sector plays, maybe even some calculated speculation. If your experiments explode, you've only lost 20%. Not everything. Principle 4. Obsessive research. Every mad scientist is buried in research. They know their field inside and out. They read constantly. They question everything. They don't just accept conventional wisdom. You cannot be a mad scientist investor without being obsessively informed. That doesn't mean watching stock tips on TikTok. It means reading financial statements, understanding business models, studying market history, learning economic principles, practical application. Before investing in anything, spend at least 5 hours researching it. Read the company's annual report. Understand their revenue model. Know their competition. If you're not willing to put in 5 hours of research, you're not willing to risk your money. The sarcastic reality check. But this sounds like work. Yes. Yes, it does. You know what else was work? Building a functional time machine out of a DeLorean. Doc didn't just wing it with a YouTube tutorial and positive vibes. If you want mad scientist results, you need mad scientist effort. If you want average results, there's nothing wrong with that. Index funds are right there. Set it, forget it, retire wealthy. That's a perfectly valid strategy. But if you want to experiment, to push boundaries, to potentially outperform the market, you need to embrace the laboratory mindset. And that means work. Running financial experiments safely. Okay, so you're convinced. You want to be a financial mad scientist. Excellent. Let's talk about how to not blow up your laboratory. The scientific method. Investment edition. Step 1. Form a hypothesis. I believe Company X will outperform the market over the next 3 years because of their innovative technology in renewable energy. Not, this stock looks cool and went up yesterday. Your hypothesis needs to be specific, testable, and based on reasoning. Step 2. Design your experiment. How much are you investing? What's your timeline? What metrics will you track? What would make you exit the position? This isn't, I'll just see what happens. This is, I'm investing 5% of my experimental portfolio for a minimum holding period of 2 years, tracking quarterly earnings and competitive positioning, and I'll exit if the thesis breaks or the stock drops 25%. Step 3. Execute the experiment. Buy the stock, crypto, whatever. Document the date, price, and reasoning. Step 4. Monitor and collect data. Check in regularly, but not obsessively. Quarterly reviews are good. Daily panic checking is not science, it's anxiety. Track. Is the company executing on what you expected? Has the competitive landscape changed? Are there new variables? Step 5. Analyze results. After your timeline, or if your exit conditions trigger, evaluate. Did your hypothesis prove correct? If yes, why? If no, why? What would you do differently? Step 6. Iterate. Apply learnings to your next experiment. Science is iterative. No single experiment defines your career. The high-risk laboratory. What to experiment with. Experiment Category 1. Individual stocks. This is your basic mad scientist experiment. Pick a company you believe in, buy shares, see if you're right. Risk level. Medium to high, depending on the company. Mad scientist example. Doc Brown investing in emerging technology companies in the 1950s. Some crashed. Some became IBM and Xerox. He would have documented everything. Experiment Category 2. Sector bets. You believe a certain sector will boom? Put money in a sector-specific ETF. Example. I think artificial intelligence will explode over the next decade. Buy an AI-focused ETF. You're not picking individual winners, but you're betting on the sector. Risk level, medium. Diversified within the sector, but concentrated in one area. Experiment category 3, options trading. Okay, now we're getting into serious mad scientist territory. Options are complex instruments that can amplify gains or losses. This is strapping rocket boosters to your investment. It can propel you forward or explode spectacularly. Risk level, high to very high. Mad scientist warning. Do not touch options until you've spent at least 20 hours learning how they work. This is not beginner experimentation. This is advanced chemistry. You wouldn't handle plutonium on your first day in the lab. Experiment category 4, small cap and emerging markets. Investing in smaller companies or developing economies. Higher volatility, higher potential returns, higher risk of complete failure. Risk level, high. Think of this as Doc Brown investing in whatever weird startup caught his attention. Sometimes it's the next Apple. Sometimes it's a company that made a solar-powered flashlight, what not to experiment with, or how to not die in your laboratory. The forbidden experiments, putting your entire life savings into one stock because a Reddit thread convinced you. That's not an experiment. That's financial suicide with extra steps. Day trading without education or strategy. That's not science. That's gambling with a Bloomberg terminal. Taking investment advice from crypto influencers with laser eyes in their profile pictures. Just know, investing in things you don't understand because they're trendy. Mad scientists understand their experiments. If you can't explain how it works, you shouldn't invest in it. Using margin or leverage without fully understanding the risks. Borrowing money to invest can amplify gains, but it can also create losses bigger than your initial investment. That's not controlled chaos. That's just chaos. The sarcastic intervention. But I saw someone on YouTube turn $1,000 into $1 million with options trading in a month. Yeah, and I saw Doc Brown travel through time in a DeLorean. One is fiction. One is extreme survivor bias. For every person who hit that lottery, thousands lost everything and didn't make a YouTube video about it. Mad scientists respect risk. They don't ignore it. The Doc Brown portfolio strategy. Let's get specific. What would Doc Brown's investment portfolio actually look like if he applied his genius to modern markets? The time-traveling portfolio. Doc understood that different time periods required different strategies. Your portfolio should too. Short-term experiments, 1 to 3 years. These are your I have a specific thesis about near-term events investments. Example, I believe electric vehicles will gain significant market share over the next 2 years. You might invest in an EV-focused ETF or specific companies in that space. Allocation, 5 to 10% of your experimental portfolio. Risk tolerance, higher. You're betting on specific near-term catalysts. Medium-term experiments, 3 to 7 years. Broader sector bets, or individual companies you believe will grow substantially. Example, cloud computing will continue to dominate enterprise infrastructure. Invest in established cloud providers or a diversified cloud ETF. Allocation, 10 to 15% of experimental portfolio. Risk tolerance, medium-high. Enough time for the thesis to play out, but not so long you can ignore market changes. Long-term core, 10 plus years. This is your boring, stable, flux capacitor. Broad market index funds. Total stock market, S&P 500. International diversification. Allocation, 70 to 80% of your total portfolio. Not just experimental. Risk tolerance, lower. This is your, even if my experiments fail, I'll still retire comfortably foundation. The 1.21 gigawatts emergency fund. Before any mad science, you need power. Your emergency fund is your plutonium. 3 to 6 months of expenses in a high-yield savings account. No experiments, no risk, just available power when you need it. Without this, your first failed experiment could force you to sell other investments at a loss to cover emergencies. That's not science. That's catastrophic cascade failure. The flux capacitor theory of compound interest. Doc's most important invention required 1.21 gigawatts of power, delivered at precisely the right moment. Compound interest works similarly. The power isn't in making one perfect investment. It's in consistent contributions, over time, hitting the precise point of exponential growth. Invest $500 a month in a diversified portfolio, averaging 8% returns. After 10 years, about $91,000 after 20 years, about $295,000 after 30 years, about $745,000. You contributed $180,000 over 30 years. Compound interest added $565,000. That's the flux capacitor activating. But it only works if you don't panic sell during market crashes. Time is the gigawatts. Patience is the lightning strike. Doc's rebalancing protocol. Once a year, check your portfolio allocation. Has your experimental section grown to 30% because everything succeeded? Great, but that's too risky now. Sell some. Move it to your stable core. Lock in gains. Has your experimental section shrunk to 5% because several experiments failed? That's fine if it's still within your risk tolerance. Maybe add more if you have new hypotheses to test. Rebalancing isn't admitting failure. It's maintaining your designed risk profile. It's recalibrating your instruments. The sarcastic warning about timing. But what if I wait for the perfect moment to invest? What if I time the market perfectly? Cool story. Doc Brown had a time machine and couldn't reliably predict lottery numbers. You're not going to time the market. Time, the market beats, timing the market. Start now. Invest consistently. Stop waiting for perfect conditions. Perfect conditions don't exist. Learning from famous experiments, successes and explosions. Let's look at some real mad scientist investment moments in history. Some brilliant, some disastrous, all educational. Successful experiment. Amazon in 1997. Hypothesis. Online bookstore could disrupt retail and expand into everything. Result. If you invested $10,000 at IPO, it would be worth roughly $20 million today. Mad scientist lesson. Sometimes the craziest sounding ideas are actually genius, but you needed conviction to hold through multiple 90% drawdowns along the way. Failed experiment. Pets.com in 1999. Hypothesis. People will buy pet supplies online with free shipping and heavy marketing. Result. Company went from IPO to bankruptcy in 9 months. Investors lost everything. Mad scientist lesson. A good idea with terrible unit economics is still a terrible investment. The math has to work. Cute sock puppet commercials don't override negative margins. Successful experiment. Bitcoin in 2011. Hypothesis. Digital decentralized currency could have value. Result. From $1 to over $60,000 at peak. Insane returns for early adopters. Mad scientist lesson. Extremely high-risk experiments can pay off, but most people who bought early also sold early or lost it to hacked exchanges. Diamond hands require conviction and security. Failed experiment. Theranos, if you'd invested. Hypothesis. Revolutionary blood testing technology will change healthcare. Result. Complete fraud. Company worth zero. Founder convicted. Mad scientist lesson. Due diligence isn't optional. If something seems too good to be true, demand evidence. Real mad scientists show their work. Successful experiment. Index fund investing since 1975. Hypothesis. Buying the entire market and holding is better than trying to pick winners. Result: outperformed about 90% of actively managed funds over long periods. Mad scientist lesson: sometimes the boring experiment is the most successful. Not everything needs to be flashy to work. The pattern recognition: successful experiments usually share traits. Clear thesis based on research patience through volatility conviction based on fundamentals appropriate position sizing. Didn't bet everything. Failed experiments usually share traits. FOMO or hype-based decisions, ignoring red flags, over-leveraging, no understanding of what they owned. The most important lesson: you will have failures. Doc Brown had countless failures. The question is, can you afford them? Are they sized appropriately? Are you learning from them? One massive bet gone wrong ends your career. Many small experiments with some failures? That's science. The mad scientist's rules of risk management. Doc Brown survived decades of dangerous experiments. How? Rules. Even mad scientists need rules. Rule 1. Never invest money you can't afford to lose. If losing this money would affect your ability to pay rent, eat, or survive, it's not experiment money. It's survival money. Don't experiment with survival money. Rule 2. Position sizing based on conviction and risk. Strong conviction. Good fundamentals. Medium risk. Maybe 10% of experimental portfolio. Wild speculation based on a hunch. 1 to 2% max. The riskier the experiment, the smaller the position. This is basic laboratory safety. Rule 3. Have an exit strategy before you enter. Before buying, decide, I'll sell if it drops 25%, or I'll hold for 5 years unless the thesis breaks, or I'll take profits if it doubles. Whatever your strategy is, decide it before emotion enters the equation. Future you with money on the line makes terrible decisions. Current you makes better ones. Rule 4. Diversify your experiments. Don't run the same experiment in different beakers. If you own 5 tech stocks, you're not diversified. You're concentrated in one sector. If they all use the same cloud infrastructure, and that fails, everything fails together. True diversification means different experiments with different risk factors. Rule 5. Keep learning. Markets evolve. Technology changes. Economic conditions shift. What worked in 2010 might not work in 2025. Read books. Take courses. Stay curious. The moment you think you've figured it all out is the moment you become vulnerable to catastrophic failure. Doc Brown never stopped learning. Neither should you. Rule 6. Emotion is the enemy. Fear and greed destroy more portfolios than bad investments. When everyone's panicking, you need discipline to hold or buy. When everyone's euphoric, you need discipline to sell or stay cautious. This is where your predetermined exit strategies save you. Follow the protocol, not the emotion. The ultimate sarcastic truth. Following these rules won't make you a billionaire overnight. They won't guarantee success. They won't feel exciting, but they'll keep you alive. They'll let you keep experimenting. They'll prevent one bad decision from ending your entire financial future. And honestly, if you're looking for guaranteed overnight riches, you're not looking for investing advice. You're looking for a fairy godmother or a winning lottery ticket. Neither is reliable. So, what have we learned from our mad scientist approach to investing? Embrace experimentation, but with methodology. Think in probabilities, not certainties. Fail forward by treating losses as data. Build a portfolio with a stable core and an experimental section. Research obsessively before investing. Manage risk ruthlessly. You don't need a time machine to build wealth. You need time, discipline, and a willingness to learn from both successes and failures. Will this approach guarantee you'll outperform the market? No, nothing can guarantee that. Will it make investing more interesting and potentially more profitable than passive strategies alone? Possibly, if you're willing to put in the work. The mad scientist mindset isn't about being reckless. It's about being curious, methodical, and willing to challenge conventional wisdom while respecting fundamental principles. Doc Brown didn't build a time machine by following the traditional path, but he also didn't build it by ignoring physics. He understood the rules well enough to push their boundaries. Your relationship with investing should be the same. Understand the fundamentals deeply, then experiment thoughtfully within that framework. Remember, the goal isn't to be crazy. The goal is to be crazy like a fox, or crazy like a genius, or crazy successful. Actually, just be smart about it. That works too. Now get out there and start experimenting. Your financial laboratory awaits. If this video inspired you to put on your lab coat and start your investment experiments, hit that like button like you're hitting 88 miles per hour. Subscribe to this channel for more financial content that your traditional advisor would absolutely hate. We cover everything from superhero finance to mad scientist investing, because money doesn't have to be boring. Drop a comment below. What's your most successful investment experiment so far? Or your biggest failure that taught you something valuable? Let's learn from each other's laboratory explosions. And remember, this video is for educational and entertainment purposes only. I'm not a financial advisor. I'm just a person with a YouTube channel and questionable metaphors. Do your own research. Consult professionals. Don't sue me when your flux capacitor experiment doesn't work out. Thanks for watching, and I'll see you in the next experiment. Great Scott! We're done here.